We're looking at the mini version of a repositioning financial model. Repositioning is the process of investing capital on a property with the aim of increasing its value through renovations or redevelopment initiatives. Our model runs statistically based on the unit of measure that we choose, square feet or square meters. It is therefore suitable to a wide array of property types such as multifamily, mobile home parks, self-storage, single-family, warehousing, industrial, or of investment case, and see this model in action. This investment opportunity involves the repositioning of a distressed multifamily building in the US. For this deal, we're going to assume we'll be closing in December 2024 and will use only as a placeholder for now a 5-year holding period, which will change later in order to exit in a year that maximizes our returns. So now our exit date is set to December 2029. We'll set our measurement units as square feet as opposed to square meters. We'll input the net rentable area that we would acquire, in this case 72,800 square feet. And if by the time of sale the property has the same net rentable area that we bought it for, in other words, if our repositioning program does not imply the activation of formerly non-rentable space, if there were any, then we would input the same net rentable area upon exit. We choose the $sign and we input our acquisition price, free of broker fees or any other transaction costs, in this case $8 million. We change the frequency of our rental rates from a yearly to a monthly basis. At acquisition, the property would be generating a base rental revenue of say $1.5 per square foot per month, which is meant to be way below market, as this is supposed to be a distressed property, but which, thanks to our repositioning and stabilization programs, increases to $2.1 per square foot per month, getting closer to estimated rental values. Let's assume that the stabilization program would take us 2 years from acquisition to complete it. During those 2 years of stabilization, we would not only get our rental rates closer to market, but we would also get rid of operating inefficiencies and improve our occupancy. These enhancements would help us increase our NOI margins from say 50% at acquisition to, for example, 65% once stabilization had been achieved. With these inputs, the model is now able to calculate a going-in NOI cap rate of 8.2% in this case, and thanks to our repositioning program, we should be able to improve that cap rate. So if right after acquisition we launched a well-thought-out repositioning program, which implied investing, for example, $2 million into the property over 1 year, we would be able to achieve an exit capitalization rate that is closer to market. In this case, let us remain conservative and go for a 7.5%. Of course, in real life, this rate would ultimately depend on market conditions, the investment cycle, and the property class. This is currently only an example. We'll decide to leverage our investment activating both the acquisition and refinancing loans. Refinancing would occur the next day after stabilization had been achieved, in this case on the first day of year 3. We'll remain conservative, setting the LTV at 60% for both loans, an interest rate of 6%, and an amortization of 3.3% per year, which roughly speaking is like a 30-year mortgage. We're simply taking the reciprocal. Let's assume that the general partner would contribute 1% of the total equity requirement and that he would charge the following fees: a 1% acquisition fee, a 3% asset management fee, a 1% disposition fee, and no loan agent fee. In terms of the waterfall drivers, let's assume an 8% preferred return and a 20% promoted interest. Now that we have populated all our inputs, let's look at our return metrics, which basically provide answers to the following questions. How much money do I need to invest? How much money am I going to make? And when will I see my money back? If the GP invested no equity capital, he would obviously not get any capital repayment, nor any preferred return, only a promoted interest, which would be equivalent to about 5.5% of the equity contributions. Let's now look at the sources and uses of funds report, which basically answers the following questions. How much funding do you need to make this project happen and achieve the returns you mentioned before? How are you going to allocate those funds across your main uses? And where would you be getting that money from? Regarding the capital stack, we see the LP-GP contribution split as well as the 60% LTV loan provided by the bank. Talking about the bank, we can get a feeling of whether our project would be accepted by simply looking at our interest coverage ratio and debt service coverage ratio and assessing whether our performance would breach the bank's covenants. Let's take a look at the graph, starting off with our balance sheet overview. We see how, thanks to our repositioning and stabilization programs, our $8 million acquisition doubles in value to reach a gross asset value of around $16 million. We also see how, because of the loan payments we're making, the outstanding loan amount decreases, separating itself from the debt capability level but reaching it again as soon as we refinance. So if we did not refinance, the outstanding loan amount will continue decreasing, allowing our net asset value to go up along with the gross asset value, but delaying the early distribution from year 3 to year 5 and therefore reducing our internal rate of return by 1.5%. If we did not use any kind of leverage, we see how our NAV is much closer to our GAV. Let's now look at our LP's internal rate of return waterfall graph. One of the interesting takeaways here is the graphical visualization of how we're allocating our value creation. We can see how at the 20.5 internal rate of return, profitability is evenly spread amongst cash flow, capital, and leverage. And after that, we can also see the impact of taxes and the GP's promoted interest. If we look at our cash-on-cash return, we see how our NOI and EBITDA yields, which by the way are on an AIC base, go up as our building becomes more financially efficient. But our cash-on-cash return does struggle with those loan amortization and interest payments. This model is useful mainly during the early stages of analyzing a value-add investment opportunity. This is usually the time when we would like, on the one hand, to determine quickly and easily whether a deal would make sense, and if it did make sense, to be able to share the idea with investors, bankers, and other potential partners using a slick and professional document around which we could have the first round of conversations to start putting a deal together. These are the analytical and communication objectives this mini-model achieves. We refer to this model as a mini-model because of its great simplicity, big picture approach, and tiny size, combined with a fine display of analytical rigor and modeling mastery, which allows it to match the results of models that are more than 100 times more robust but also heavier and more time consuming to operate. For example, the deal that we are currently showing on the screen was originally underwritten by one of the largest real estate investors in the world, whose assets under management currently surpass $100 billion. To perform that underwriting, they used a combination of both a very powerful and expensive real estate software and a very bulky Excel model template, which contained more than a dozen worksheets, many of which were ultimately inefficient or useless, that were assembled by an army of real estate professionals over an extended period. In their model, changing one single assumption and assessing its impact would take several minutes, a lot of Excel work, and substantial computing power, and would still not convey a clear message about the change, as models as cumbersome as those ultimately end up becoming a black box. After months of structuring the deal on their financial model, that army of professionals at last got to a final capital raising version whose results quite closely match the results we're looking at the screen right now in our mini model. The difference is that with our model, it only took us at most 5 minutes of modeling, not 5 weeks, to figure out whether the deal made sense. This model gets the job done pretty nicely and meets the highest institutional standards.